Technology. Hey,
Right.
everybody, welcome to another session with Investing Education Academy. I am Brent Simpson with Leon Noble, and we are the co-founders of Investing Education Academy. So first, wanted to say happy holidays to everyone. We are now in that season. We're wishing you and yours the best. And for those of you all who it's not the best time of year, we want to let you know we're thinking about you, and that for everybody out there who is in need, find what you need. If you need help somewhere, talk to a friend, talk to family, talk to whomever's around. But during this time period, it's rough for a lot of people, and we first want to say we recognize that, and we experience it as well. But we just let you know people out there that care. And I think it's important to say this time of year. So now some of you all are feeling anxiety because of what's been happening recently in the stock market, and you're like, I don't know what's going on, but I know my portfolio doesn't look like what it used to look like. We're going to talk about that today. But for those of you all who are interested in joining Investing Education Academy, we are still running our Black Friday / Cyber Monday / We Care About You sale. You can go to www.ieanow.com. I don't know how long you want to do this for, Leon, but I don't think it's going to be that much longer. So if you've been on the fence about joining Investing Education Academy, we suggest you do so. Again, I'll go back to last year. It was a 50% off sale, and many of you took advantage. This year it's 20%, and like we told you last year, you'll probably never see that again. 20% might be rare in the future too. So if you want to join, you should take advantage of the Black Friday / Cyber Monday / We Care About You Happy Holiday sale. Yeah, and we have some new IEA crypto bulls, and the information in the crypto bulls has slid into the metaverse, the NFT space, IDOs. I mean, you name DAOs. I mean, we're pretty much covering it all. So if you've been wondering, like, what is this metaverse talk? What's going on? Today, with the market down on the crypto side, I know personally I woke up with about a couple thousand extra in my account that wasn't there before. So you really should be diversifying your investments, and cryptocurrency is a great way to diversify. So with that being said, I'll stop. And Leon can tell you why we chose this topic, while I'll do a little bit of housekeeping.
Yep. And just to piggyback on that crypto thing, so posted inside the membership earlier today that another example of why crypto is just, we all believe it's going to be the future, and it's not just us. Corporate America is telling this too. Today, Square announced.
With that being said, sorry about that.
Yeah, I'll say I can hear myself. Square announced that they're changing the company name from Square to Block, and they're doing that because their founder, Jack Dorsey, is huge. He's big all into blockchain and crypto. And we're going on a tangent here. I'm just going to make this real quick. Yeah. Also, Jack Dorsey is the founder of Twitter. He stepped down from Twitter as the CEO last week or earlier this week to focus strictly on Square. And then once he did that, he's now changing the name from Square, the name of the company from Square to Block, because he really is all about Bitcoin, is all about cryptocurrency. And he's kind of shifting the whole focus of the company towards that. So just kind of goes back to the point of, if you're not taking this crypto thing seriously, please start taking it seriously, because it is going to be the future of finance. And all the big companies on Wall Street, now we're seeing, Facebook changed from Facebook to Meta to deal with the metaverse, which is backed by crypto. And now Square changed the name from Square to Block, short for blockchain, which is crypto too.
And I just wanted to say, for those of you all who haven't seen, what's center in New York? What's the name of that stadium? They just changed the name
to Madison Square Garden.
Yeah, but what they changed their name to is crypto.com.
No, that's in LA. It's the former state. Yeah, the former Staples Center, where Kobe made famous. Rest in peace. They changed, so the crypto.com is a crypto exchange. They bought the rights to the Staples Center. It's no longer called the Staples Center. It's now called crypto.com Arena. A lot of people are mad about it. A lot of people don't like the fact they changed the name. But hey, shows the times we're in. Crypto.com is now the name of the Staples Center. So that just shows. And I think the deal was worth like either 200 is a big range, either 200 million or 700 million over like, I don't know, 10 or 20 years. I mean, a huge amount of money.
And we both own the coin that was responsible for, of the company that was responsible for the deal. So we saw a bump. Did you?
Mm-hmm.
Like, did you make money from the name change? We did. So, I hope, again, like we said, we're, this stuff is real time. I mean, we have governors of states now saying that they prefer to get payment, some, not all, in Bitcoin. So if you think there's someone in a powerful political position who's going to choose to get a lesser fee, you're wrong. Like, it's a reason why some are saying they'll actually accept their checks in Bitcoin. So
okay, so we're all right. Let's
yeah.
So that was our kind of ad hoc crypto spiel. So
it's real. It's real, people.
No, it's very real. It's very real.
Not a drill.
But most people are in the stock market. So we're going to explain why the market has been absolutely crazy the last 2 days. So I'm just give a quick background. So just bear with me, and it's gonna be a little wonky. But so what happened on what's today? It happened on Monday? The chairman of the Federal Reserve, his name is Jerome Powell. He was up on Congress, testifying to Congress about, I don't know, I don't know what the topic was, but he was asked about. So just let me take a step back. So back in March of 2020, when COVID hit, the Federal Reserve, what they did was they lowered interest rates to effectively zero, right? And people that don't know, the Federal Reserve essentially controls interest rates in the economy for the most part. And I'm not going to get into how that works, but just know that the Federal Reserve effectively controls interest rates in the economy. So they lowered interest rates to effectively zero. The reason why they did that is because they knew the economy was shutting down, the world was shutting down, but they still wanted individuals and businesses to continue to borrow money and actually spend in the economy. So if you can borrow money at 0%, you're more likely to take out a loan, take out a personal loan, take out a business loan, maybe use your credit card. More that the rate is now lower. Now, the rates for these loans, everything out in the world, they didn't go to zero, but a lot of these loans rates went to close to 1-2%, down from maybe 3 to 5%. So they dropped almost in half or more than half. So that kept money flowing through the economy, right? So interest rates were dirt cheap. Now, the reason why that matters to us as stock investors is because right now stocks are the only game in town to earn yield or to earn return on your money. You cannot get it in savings accounts, as Brent and I preach all the time. Please get your investment dollars out of savings accounts. You can't get it in CDs. You can't get it in money market. And the reason why you can't get any return in those bodies is because the Federal Reserve lowered rates to effectively zero. And just real quick, so did you wondering why? Well, if it's zero, why is my rate not zero? It's because there's something called prime. So banks take what the Federal Reserve lowers it to and then adds prime, what's called prime, and that gives you a bit of a number. So if rates are near zero, not at zero, but near zero, then you add this prime number onto it. You get a range of like maybe 1 to 3% of rates you may see right now, and maybe on some loans. Savings accounts, we all know the average rate for savings account is 0.05%. That's damn near zero. So I say all that to say there's no return anywhere in any interest-bearing asset, right? So everybody's money is going into the stock market. That's why the market has been raging the last it's really since 2009. Since the credit crisis in 2009, the Fed lowered rates, and they really haven't really come back up, and they went even lower during COVID. Okay, so that's the background of rates. So why am I talking about this? Because just real quick, the way the Fed lowers rates is they do something called bond buying. So again, not getting too deep into it, but just understand that when the Fed buys treasury bonds, that lowers interest rates in the economy. So that's how the Fed lowers rates. So they've been buying these bonds. It's something like $50 billion a day in bonds since March of last year, keeping rates artificially low, right? So yesterday, in front of Congress, Jerome Powell announced that they're going to stop this bond buying process or what they call facility. They're going to stop it maybe early to mid next year. And that was a lot earlier than people had anticipated, right? So what does that mean? That means is rates are going to start slowly rising relatively quicker than we thought, right? So what that means is things like CDs, money markets will have higher rates. They're not going to be competing with the stock market relative to returns, but they will have higher rates. You may see over the next year or two, you may see rates right now. Rates are anywhere from like I said, 0.05% to maybe up to like 2%, right? Just depending on what you're investing in. So what's going to happen when they stop this bond buying and rates start rising? You're going to see rates go to like maybe 2.5, maybe 3%, right? Now to us,
I think
that's
3 would be really high.
Yeah, well, yeah, it would, right? Yeah, so but that's what I'm saying. Rates are still going to be low, but here's the thing: if you have $50 million or $1 billion, if you can lock in 2% return and have no risk, you're going to do that all day, right? You do that.
$1 billion.
Yeah, if you have a billion, if you have $1 billion, you're going to take that $1 billion, you're going to lock in 2% versus taking that $1 billion and putting it in the stock market, which we all know can crash at any moment, right? So what's happening right now is rates are slowly going to start creeping up over the next year and a half, 2 years. So the reason the stock market is going crazy right now is because people are starting to position their portfolios to say, okay, if rates are going up in the next, say, 6 months to a year, I'm going to start withdrawing some money now, start building up some cash. So when these money market rates or these CD rates go up to say maybe 1.5, let's say maybe 1 to 1.5%, I'm going to lock that in with my $1 billion and sit back and have no sweat, right? No, because remember that's guaranteed because mostly they're going to be done through treasuries or even money market, which is a stock market, but it's a lot more. The risk is a lot more diversified. So so the reason we're seeing all this volatility right now is because market participants, people that have a lot of money, hedge funds, pension funds, are starting to withdraw some money from these really, really risky stocks like tech stocks, biotech stocks that don't really have much earnings because we're looking at the future. It's starting to withdraw some of the money and say, look, if I can lock in, let's say 1 or 2% now, I'm going to do that. I'm going to take some money out, build up some cash, and then invest that money when these rates go higher. So that's why the stock market is kind of in this topsy-turvy thing right now because rates are slowly going to start creeping up over the next 6 months to a year. And the way we handle it, so how does that affect us, right? So the way we handle it as investors, so I know a lot of people that watch Brent and I that are involved with us are involved in tech stocks. My portfolio is like 35% tech. Brent, yours might even be more.
Like 60.
Yeah, right. Let's see. So us tech investors, we're gonna feel more pain than most. The reason is that a lot of tech companies, especially these new IPOs, and I know a lot of us are in some of these more speculative names, they have no earnings, right? Their earnings are, their revenues are growing great, 20, 30% per quarter, but they have no earnings and they're not projecting to actually make any money for like 2 or 3 years, right? So again, what happens is if somebody has $1 billion, can take that $1 billion and put it in a treasury bond that's going to pay them 2%, lock that in for the life of that bond, versus put it into a biotech or a tech stock that may not be around in 2 or 3 years. What they're going to do? They're going to take that money and put it into that pretty much guaranteed return. So so us tech investors, we may feel a little bit more pain because a lot of these tech stocks that have no earnings are really going to get hit as rates start to rise. And so what I've started doing is I started kind of paring down my portfolio as far as the risky tech stocks. Like I'm moving more of my money into like Microsoft, Google, Facebook, things like that, and moving it out of some. I had a few SPACs, I had a few biotech that really have gotten hit lately, and so I'm starting to pare those down a bit and move my money into more stable technology versus the more risky technology. And again, just go back to the main point. This is all happening. All this volatility is happening because rates are going to start rising soon. The Federal Reserve has let us know that this is going to happen. It's no longer like speculation. When will it rise? Will it rise? Maybe it won't. No, rates are going to start rising. So there's going to be competition in the marketplace for investment dollars. People are going to start moving their money into treasury bonds, into bonds, into money markets, into CDs because the rates are going to slowly creep up. And again, you have $1 billion, you're going to lock in 2% versus put your money in a biotech that may not be around in a couple of years.
Yeah.
So,
also too, it's the end of the year. So normally at the end of the year, historically, December, people pull out their money for vacationing. People pull out for some profit taking. Some people pull their money out to capture loss, to offset taxes. So December is normally a year when the market drops. Also until you get around that Santa Claus rally. But December as a whole is normally you see the market pull back. And on top of this news, and also don't forget it's a new strain of COVID. So, you have that to contend with. So I don't think you're going to see what happened in 2020 happen anytime soon, but you will see the world adjust again to COVID in a new way, and we're getting a piece of that now. So just think about what you're doing with your money.
Yeah, so that's a good point. The thing about the Santa Claus rally. So there's this phenomenon called the Santa Claus rally, right? And that's just kind of the feel good. Everyone feels great. The holiday season, and the stock market typically rises into the end of the year. I think we did a podcast on this last year, if I remember correctly. But I think the Santa Claus rally is not all of December. Like Brent said, December can be a bit volatile. The Santa Claus rally is typically the last week of the year. So really going into Christmas and then going into New Year's is when the market really kind of takes off into the new year. So December can be quite volatile. The Santa Claus rally is not the whole month. But as Brent said, the new strain of COVID, that we got our first case, confirmed case in the U.S. today. And then on top of that, and some people was like, oh, that's the reason the market is going crazy. That's part of it. But the main reason, because as we know, COVID eventually will kind of move to the background, right? But rates rising will not. Rates will continue to rise up to a certain point, but they will continue to rise kind of into the foreseeable future because inflation. Inflation is the fact that money is so cheap. All this money is chasing finite goods is pushing the price of everything up. So when you raise rates, people start to pull back on those loans, mortgage loans, business loans, and it kind of helps bring down inflation. So that's the two main reasons. The main reason you're seeing volatility in your account right now is Jerome Powell yesterday announced that they will stop the bond buying, which is going to cause rates to rise. So there's now competition for the stock market for people to put their investment dollars, which over the last year since COVID, there's been no competition. The stock market's been it because rates were basically at zero.
And also too, I'll say now you have a lot of people who are divesting from the market because of just the environment we're in, and they're investing in cryptocurrency. The whole cryptocurrency ecosystem. Let's just say that. Even some of the stuff that we do now is more focused towards invest stock market and cryptocurrency. And for anybody watching, you really need to understand that the people who are moving their money, like I laughed when Leon said $1 billion. I kept thinking about the Austin Powers movie. But the reality is those are the people that really can hedge with billion-dollar positions. The average person, you still need to have your money in the stock market. You still need to have your investable dollars still need to be in the stock market. Your investable dollars still need to be in real estate, in entrepreneurship, because leaving your money in the savings account, anybody watching this who's a regular person, if you will, who goes to work, saves part of their check, if you're putting your money in the savings account, let's talk about this real quick. The interest rate still is at 6.25%, I believe, or
6.2%. 0 point.
No, inflation.
Oh no, inflation is 6.2. Yeah, inflation is at 6.2%, whereas the interest rate in the savings account is 0.05%.
So even if it goes up to 2, which I think 2 is going to be our max, even if it goes up to 2, you're still talking about being negative 4.2% against, or receiving negative 4.2% buying power as it relates to inflation. And so for anybody who thinks that's a really good deal, just give your neighbor 4% of your money every day forever and just see how it feels. It won't feel good. It just feels okay because it's not money that you're taking out your pocket. It's invisible deterioration of your buying power. But it's very real. We promise you. We have discussed it many times about the cost of milk, the cost of bread, the cost of gasoline. All these things are going up. And I'm telling you, for those of you all who are, real estate flippers and such, when interest rates go up, in most environments, there's an inverse relationship between interest rates and the price of homes. So as interest rates go up, the price of homes tends to come down. So for those of you all who, you're flippers, or you think, oh, I'm just going to keep riding this appreciation of my real estate, more than likely, it will also take a hit in this environment. You need to make sure your money is working for you in as many places as possible. Leon and I do these lives because we honestly just want to be useful to you all. We want to provide a service of education to help you understand savings accounts and where you believe your safe money is not safe. So again, I want to just make sure you understand this. When Leon was talking about these people moving their money into CDs and savings accounts, maybe a CD might get to 3%. But you're talking about institutional money. You're talking about big money. You're not talking about a person that's putting $100,000 away because that's all they have in the world. Like, that's not where your money, in my opinion, I've only speak for Leon. In my opinion, that's not where you want your money to be if it's investable dollars.
And also make the point that when I say rates are going to rise, I'm not saying rates are going to go from close to 0 to like 3%. No, this is going to be a slow grinding rising of rates. Now here's the other thing. So when the Fed stops buying bonds, probably early, maybe first quarter next year, rates are gonna start rising as that approaches, right? So as that approaches, maybe first quarter next year, rates will kind of tick up a little bit. Now, you're not gonna see, you can look at your savings account interest rate right now, and look at it in March next year. It'll be basically the same, right? Won't change much, because again, when the Fed stops buying, banks are not incentivized to quickly raise your rate, right? They don't really need to. So they're gonna fight before they give you any incremental increase. So look at your rate now, look at your rate in March. It'll be basically the same. The other thing that's gonna happen once the bond buying stops, the next thing is then the Fed typically physically raises interest rates. But when they raise rates typically by 0.25%. So 0.25% is what the Fed typically raises rates by when they raise. So again, we're not talking about big raises here. You're not going to go from your 0.05% now to all of a sudden see 3% of your savings account. I would say we wouldn't see that in our lifetime. But again, for people that have big money, 50 billion, 100 billion, $50 million, getting 2% on their money is worth it to lock that in for however many years versus put that in the more risky stock market. Individuals like us, retail investors, we don't have that luxury, right? We need that higher return. We need that 10, 20, 30% return per year to have the money, to make a lot of money for us. That 2%. I mean, even if your savings account got to 2%, again, inflation is typically 2 to 3%. So you're still just going to be breaking even on inflation and really not earning any money, right? So I don't want anybody to walk away from this thinking that, rates are going to be going up soon, I can go back to my savings account. Not saying that at all. We're just saying that the reason the stock market is showing a lot of volatility right now is because big money is setting themselves up to move their money out of the stock market and into some of these treasury bonds that are going to see the rates rising maybe to 1.5%, maybe 2% over the next year. Last point, what do we do about it? You want to invest in stocks that benefit from rising rates. Number one is banks, right? Banks, they make a lot of their money from lending from loans, right? So as rates rise, they're going to charge us, the retail, the people that get loans, more money where they make more money. Also, mortgage companies, that do mortgage loans, they make their money from interest on those loans. Those are going to go up slowly as well. So you can look for companies that benefit from rising rates, and you may want to it's up to you, but you may want to move your money out of or kind of stay away from the more risky tech stocks, because again, that's where a lot of this liquidation is going to happen. And the big money's move their money out of those into things that will benefit from rising rates, or just setting themselves up to buy treasury bonds, CDs, things like that in the future when rates rise.
Yep. So everybody, we will give you what we owe you. And that's our picks. As we now do, we will post one of our picks inside of the IEA group on Facebook. So if you're listening to this and you're like, when I get home, I definitely want to check that out, you can go pull up Facebook or Meta, and you can.
Well, no. Facebook, the Facebook platform is still called Facebook. The parent company is now called Meta. It's like Alphabet, Google.
Alphabet and Google.
Yeah, same thing. Yep.
I just like saying it. Go to Facebook. Correction, I've been corrected. And go to Facebook and type in Investing Education Academy. We should pop up, and you can join our group. Our Facebook group is free. If you want both picks, you can go to our IEAnow.com website or IEAmembers.com. Either one will get you there. And you can go inside the platform if you're already a member. If you're not a member, please join. And you can get the other pick. Well, actually, you'll get both there. because we catalog all of our picks on the platform. So again, we really do appreciate all of you all for listening. We wish you all happy holidays. For all of you all dealing with loss during this time, we know it can be hard, and just understand there's places you can go if you really truly feel alone. If you have the ability to reach out to a family member, please do so. Take advantage of the environment and friends and so forth who want to be there for you, but they need to know that you need help. You need somebody to talk to. I think that's a really important point because a lot of people suffer during this time, and we care. We definitely do care. So Lee, did I miss anything?
No, that was it. That was. I think we're good.
All right. So everybody have a beautiful day. Happy holidays. We will see you all next Wednesday, and we look forward to talking to you then. Have a good one.